Good afternoon, everyone. I'd like to call this meeting of the Council to order. Thank you for joining today's meeting. And I want to note that Superintendent Dwyer is joining us virtually today. We have two items on the agenda today. First, we'll hear a presentation from Treasury staff on the Council's analytic framework on financial stability risks and interpretive guidance on non-bank financial company determinations. Then we'll have votes on the framework and the guidance, and then we'll vote on the minutes of our last meeting. Our first agenda item is to discuss and vote on the Financial Stability Oversight Council's analytic framework for financial stability risk identification, assessment, and response, and on the Council's interpretive guidance on non-bank financial company designations. Before we turn to the presentation, I'd like to explain why I believe it's so important for the Council to achieve greater public transparency and analytic rigor, and how these two documents will help the Council do so. Financial stability is a public good. The U.S. financial system enables people to make payments, build businesses, save, and manage risks. To fill our needs, it has evolved to be complex, diverse, and interconnected. We rely on it every day, and it has succeeded in supporting American families and businesses, enabling wealth creation and economic growth over generations. But when it falters, we can experience financial crises that can devastate households and businesses for years afterwards. This is where the Council, or FSOC, comes in. Congress created FSOC after the global financial crisis to identify and respond to risks to financial stability. To maintain the strength of the financial sector, we need a nimble but robust structure to monitor and address the buildup of risks that could threaten the system. In the lead-up to the global financial crisis, inadequate oversight led to reckless risk-taking. When large, interconnected financial companies failed in 2007 and 2008, stress spread through the financial system and then to the real economy. The reforms implemented after that crisis substantially strengthened the financial system, and the banking system as a whole remains strong. But recent stresses in some financial sectors arising from the onset of the pandemic and the sudden failures of some regional banks underscore the continuing need to remain vigilant to threats to ensure the resilience of the financial system and our economic strength. This is the purpose of the Council, and our two votes today go to the heart of FSOC fulfilling its critical mission. Our first vote will be on approving the Council's analytic framework for financial stability risks. This framework will help the public better understand how the Council goes about its work and how it draws on its various statutory tools to respond to risks. For the first time, it provides a clear explanation of how the Council monitors, evaluates, and responds to potential risks to financial stability, regardless of whether they come from activities, individual firms, or other sources. Under the framework, the Council's response to a particular risk to financial stability will depend on the nature of the risk. Often, risks emanate from widely conducted activities and can be effectively addressed through action by an existing regulator or interagency coordination. Other times, risks are instead concentrated in one or more specific non-bank financial companies. And this brings me to the Council's guidance on non-bank financial company designations. Among the tools Congress gave the Council is the authority to designate a non-bank financial company for Federal Reserve supervision and prudential standards if the company's distress or activities could pose a threat to financial stability. The guidance we're voting on today will help ensure that the Council is able to use this authority as needed. It describes in detail the procedural steps for the Council's review of non-bank financial companies for potential designation. These involve rigorous analysis and transparency. The guidance maintains strong procedural protections for companies under review, including significant Council engagement and communication, and provides them with opportunities to be heard. The guidance also affirms that the Council will engage extensively with companies' primary financial regulators. The guidance also eliminates several prerequisites to designation in place under current guidance that were not contemplated by the Dodd-Frank Act and that are based on a flawed view of how financial risks develop and spread. And again, designation is only one of the Council's tools and is not being prioritized over other approaches to addressing financial stability risks. In voting to adopt the analytic framework and guidance, we will increase the transparency of the Council's work and establish a durable process for the Council's use of its designation authority, strengthening the Council's ability to promote a resilient financial system that supports all Americans. With that, let me turn to Sandra Lee, Treasury's Deputy Assistant Secretary for the Council, for the presentation. Sandra.
Thank you, Secretary Yellen. It is a privilege to present the two documents for the Council's consideration: the Analytic Framework for Financial Stability Risk Identification, Assessment, and Response, and the updated guidance on non-bank financial company designations. The Council issued these proposals in April. After the comment period closed, interagency staff carefully considered the wide range of public comments. The two documents that the Council will vote on today reflect that public input. I will begin with a description of the analytic framework and the changes made since the proposal, and then follow with a discussion on the non-bank designations guidance. The analytic framework provides a public description of how the Council identifies, assesses, and responds to potential risks to financial stability, whether they come from widely conducted activities or from individual firms. The Council has never before issued a framework describing how it broadly approaches risks to financial stability regardless of origin. The framework focuses on three components. First, to identify risks, the Council, in consultation with financial regulators, monitors a broad range of financial market developments, entities, and activities. The framework lists examples of asset classes, sectors, and activities that the Council monitors. Second, the Council works with existing financial regulators to evaluate potential risks and determine if they might warrant additional action. These evaluations will be data-driven and fact-specific. The analytic framework specifies 8 vulnerabilities that most commonly contribute to financial stability risks and the channels by which the vulnerabilities can increase risk to financial stability. This type of analysis can be applied regardless of whether the Council is considering risk from activities, particular firms, or other sources. Third, to respond to identified risks, the analytic framework underscores that the Council has a variety of approaches. In many cases, the Council works with financial regulators to seek the implementation of actions to reduce identified financial stability risks. Alternatively, the Council may issue recommendations to regulators or to Congress. In other cases, the Council may use one of its designation authorities. The analytic framework does not prioritize any of the Council's tools over another. Instead, the Council's actions depend on the nature of the identified risk. Based on public comments, the analytic framework includes a number of changes from the April proposal. First, the framework provides additional transparency regarding how the Council interprets the phrase threat to financial stability. This term was not defined in the proposal, and some commenters suggested that the public would benefit from a better understanding of the Council's view. The analytic framework therefore builds on the description of financial stability that was included in the proposal. The analytic framework interprets threat to financial stability to mean events or conditions that could substantially impair the financial system's ability to support economic activity. Second, in response to public commenters' requests for additional detail on some of the vulnerabilities and transmission channels that were identified in the proposal, the framework now includes more information on these factors and more sample metrics that the Council may consider. Third, based on public comments that requested an explanation of the interplay between the listed vulnerabilities and transmission channels, the analytic framework specifies vulnerabilities that may be particularly relevant for each transmission channel. Finally, some commenters highlighted the importance of the Council's engagement with existing financial regulators. The Council has had a long history of working very closely with primary regulators, and the framework now includes additional emphasis on the Council's extensive engagement with state and federal financial regulatory agencies. Now, I will turn to the second document for your consideration today, the Guidance on Non-Bank Financial Company Designations. The guidance is intended to establish a durable process for the designation of non-bank financial companies, restore the Council's ability to address threats to financial stability that could be posed by specific entities, and to provide enhanced transparency to the public and to financial companies. As a reminder, the Dodd-Frank Act itself establishes the standard for designations and the list of factors the Council must consider in any designation. The Council's guidance does not alter those statutory requirements. Under the law, a non-bank financial company can be designated only if the Council determines that the company's material financial distress or its activities could pose a threat to U.S. financial stability. The guidance describes the procedural steps the Council would take in reviewing a non-bank financial company for potential designation. The process would involve substantial engagement with companies under review and their existing regulators. Under the guidance, the Council would expect to follow a two-stage process. A company identified for review would be subject to preliminary analysis based primarily on information from public and regulatory agencies in stage one of the process. The company would be notified and allowed to submit information to the Council at least 60 days before the Council votes on whether to advance the company to stage two. If the Council determines a company should continue to be reviewed, staff representing the Council would engage extensively with the company in stage two. Stage two involves significant two-way communications with the company under review and its primary financial regulator. If the Council's preliminary analysis has identified particular risks as the focus for evaluation, the company will be notified of those issues, enabling the company to understand and address the concerns. At the conclusion of stage two, the Council may make a proposed designation with a 2/3 supermajority vote of Council members. After a proposed designation, the Council issues a written analysis to the company, and the company may request a hearing. After any hearing, the Council may vote to make a final designation, which requires a separate 2/3 supermajority Council vote. For any designated company, the Council would publish the explanation of the basis for the designation and encourage the company or its regulators to take steps to mitigate the identified risks. The Council would reevaluate all designations at least annually and rescind a designation if the company no longer meets the statutory standards for designation. The new guidance removes 3 prerequisites to the designation authority that were created by the guidance by the Council adopted in 2019. Specifically, the 2019 guidance states that the Council would defer to existing regulators before considering a company for potential designation, perform a cost-benefit analysis of any designations, and assess a company's likelihood of material financial distress. These steps are not legally required, are not useful or appropriate, and unduly hamper the council's ability to use its statutory authorities. By removing these unwarranted hurdles, the revised guidance restores the availability of the council's designation authority without prioritizing any one of the council's tools over another. Our expectation is that any council designation would be based on rigorous, transparent, and data-driven analysis. Today's framework and guidance would increase public transparency of the council's work, helps ensure a rigorous process for mitigating risks to our financial system, and strengthens the council's ability to identify, assess, and respond to potential risks to financial stability. Thank you, and I'm happy to answer any questions.
Thank you, Sandra. And before we vote, I know that there are some council members who'd like to say a few words. Let me invite Chair Powell to start us off.
Thank you, Madam Secretary. And thanks, Sandra, for your great presentation and to staff for your excellent work on these documents. So I support finalizing the non-bank designation guidance and the analytical framework. I support both documents. I think these documents strike an appropriate balance between the activities-based approach and preserving designations as one of the tools that is available to the Council. These documents will provide important additional transparency regarding the Council's views on financial stability and the tools that are available to the Council to address financial stability risks, and I am delighted to be able to support them. Thank you.
Chair Gensler.
Thank you, Madam Secretary, and I want to thank Sandra and all the staff for the excellent work you've done and all my fellow members on the two documents, which I'm pleased to support. History is replete with times when tremors in one corner of the financial system, whether at a bank or other financial institutions, spill into the broader economy. And when this happens, American workers, businesses, and families inevitably get hurt. We've all seen this. Such risk can emanate from any part of the financial system, again, whether it's banking or non-bank sector. And as Americans, we've all lived through such events, witnessed how they affected American families and workers. And I look around this council right now, and it does occur to me that many of us have lived through these events also in our professional lives. So, starting with Chair Powell and Chair Grunberg, if I may, I believe that you may have the most seniority on these matters. It was more than 30 years ago that you each worked in the cleanup related to the savings and loan crisis. One as a young Assistant Secretary of the U.S. Department of Treasury, and the other as a younger staffer on the Senate Banking Committee. But it's not just there. Secretary Yellen, Vice Chair Barr, I think that while in previous roles, you each lived through some of these events in the late 1990s. I'm talking about events when the non-bank sector really came in and disrupted everything. I mean, it related to what was called the foreign debt markets and so forth, but those were trying times. I vividly remember and recall 1998 witnessing the near collapse of the highly leveraged hedge fund long-term capital management when I do remember working with some of the New York Fed's predecessors, wherever my friend President Williams is. In a President's Working Group report after that long-term capital management near collapse, we found, I say we because I was in a different role, but Treasury, the Fed, the New York Fed, the CFTC, and SEC found, quote, that those events, quote, highlighted the risk of excessive leverage and the possibility that problems at one financial institution could potentially pose risk to the financial system as a whole, end quote. And of course, that was a highly levered hedge fund, a non-bank financial firm. I think nearly all of us around the table, I'd be here too long if I named all the names, all of us around this table worked through the unfortunate, I say unfortunate, that's an understatement, events coming out of the 2008 financial crisis. Some working on the Hill, like Russ, some in the administration, but we were all in different ways working through that crisis. And that emerged again from both the banking and non-bank sector, including mortgage originators, investment banks, even the then largest insurance company, AIG. Where am I going with this? Thus, it was established, this council was established by Congress, Section 111 of the Dodd-Frank Act. And Congress empowered this council with the authority to designate non-bank financial companies as systemically important financial institutions, Section 113 of that act, which would then be regulated and supervised by the Federal Reserve, that there were some non-bank financial that needed that extra thing. Over the past decades, the non-bank sector has continued to grow. If anything, it's grown so much that by some measures currently well outpaces the size of the commercial bank sector. Thus, I believe the guidance we're considering today is important in reinvigorating the Council's designation process in a manner consistent with Congress's vision. I think it will restore critical elements of the initial role that first council, that I believe, again, Chair Grunberg, you were on that council voting for that at that point in time. I was there as a witness. And I think it also adds the framework that Sandra so went through. As I think it's an important step, but it's not the only step. I believe that each of our agencies still have important roles within our respective authorities to enhance resiliency of the financial system. At the SEC, we've taken this up in many ways, money market funds and shortening the settlement cycle, among others, but we still have important ongoing work under Secretary Yellen's leadership, along with the Federal Reserve, along with the Commodity Futures Trading Commission, to enhance the resiliency of the Treasury markets. We also have critical work along with Chair Benham and his colleagues at the CFTC regarding updates to data collection around Form PF. I look forward to completing those projects as well as voting on these two things today. Thank you.
Thank you, Gary. And let me say we've revived the work of the hedge fund working group, and the information on Form PF can be very helpful in evaluating those risks. So I hope you'll be able to get that work done. I think it would be important. Chairman Grunberg.
Thank you, Madam Secretary. Gary, I have to say you really know how to hurt a guy. And let me echo the thanks to Sandra and the FSOC staff really for their outstanding and very dedicated work to bring these two proposals, hopefully, to finalization today. In the aftermath of the 2008 global financial crisis, Congress included in the Dodd-Frank Act a set of authorities for regulators to use in response to the systemic risk posed by non-bank financial institutions. This includes the ability of the FSOC to instruct the Office of Financial Research, to collect information on non-banks, to designate systemically important non-banks to be supervised by the Federal Reserve, and to designate systemically important financial market utilities and payment clearing and settlement activities for additional risk management standards. These authorities serve as a basis to begin to address the systemic risk concerns presented by non-bank financial institutions, namely the lack of transparency, prudential supervision, and controls on the use of leverage. Under the leadership of Secretary Yellen, attention to the systemic risks posed by non-bank financial companies has been a top priority of the FSOC. In February of last year, the FSOC issued a statement on non-bank financial institutions announcing the reestablishment of its hedge fund working group, the establishment of a new open-end fund working group, and a statement of support for the efforts underway by the Securities and Exchange Commission to reform money market funds and strengthen the short-term funding markets. In addition, the FSOC annual report encouraged regulators to coordinate closely to collect data, identify risks, and strengthen oversight of non-bank companies involved in the origination and servicing of residential mortgages. And FSOC renewed a working group to review the risks and possible regulatory responses to that sector. In April of this year, FSOC published for comment a proposed analytic framework to explain how the Council typically identifies, assesses, and addresses potential risk to financial stability. This framework, which details common vulnerabilities and transmission mechanisms through which shocks can arise and propagate through the financial system, is intended to inform the FSOC's work to review the non-bank issues. And finally, in April of this year also, FSOC proposed new guidance for how it would review whether to use its authority to designate non-banks for heightened supervision and resolution planning requirements. The revised guidance would remove several constraints to FSOC designation while retaining a multi-stage deliberative process with opportunities for firm engagement. After carefully reviewing public comments received, the FSOC is meeting today to finalize both the analytic framework on financial stability risks and the interpretive guidance on non-bank financial company determinations. I am strongly supportive of both of these proposals. The analytic framework will enhance the transparency of the FSOC's process for considering financial stability risk, and the interpretive guidance will restore the practical use of the designation authority. These are critical steps to advance the ability of FSOC to address threats to financial stability from non-bank financial institutions. It is important, in my view, for the FSOC to be willing to utilize all of the tools at its disposal to address this challenging issue. Let me conclude by once again thanking Secretary Yellen for her leadership in this very important area. Thank you.
Thank you, Marty. Acting Controller Sue.
Thank you, Madam Secretary, for your leadership on this issue. I strongly support the adoption of the guidance and the analytic framework. The Dodd-Frank Act provides the Council with a number of important tools for monitoring and mitigating risk to U.S. financial stability. It's important that the Council have the ability, willingness, and the people, processes, and systems in place to use them when warranted. This guidance and the analytic framework help strike the right balance for enabling that. Having had a front row seat to the failure of AIG during the financial crisis, I have a keen sense of the importance of today's measures. They restore the options available to the Council under the Dodd-Frank Act, and more importantly, will help the Council to effectively detect and prevent threats to financial stability. I really want to thank Sandra and the team for your leadership on this. It's some really great work. Thanks so much.
Thank you, Director Chopra.
Thank you so much, Madam Secretary, and thank you to Deputy Assistant Secretary Lee for the presentation and all the work. Financial history is often cyclical, and the years following financial stability, regulators and policymakers' memories fade. Of course, families across the country don't have that luxury. The economic and psychological damage inflicted by a crisis lingers for many years. At the CFPB, we still hear from the individuals who continue to experience the financial traumas from 15 years ago. Many of them did not receive extraordinary assistance at that time. Congress directed the Financial Stability Oversight Council to, quote, promote market discipline by eliminating expectations on the part of shareholders, creditors, and counterparties of such companies that the government will shield them from losses in the event of failure. More specifically, under Section 113, the FSOC is tasked with designating systemically important financial institutions that pose a threat to financial stability. Designated firms may be required to have more skin in the game to absorb losses, more cash on hand to mitigate the impact of runs, and file living wills to demonstrate the firm can fail without extraordinary government assistance. The FSOC currently has a total of 0 firms designated under this authority. In the past few years, this has led to a perception among certain market participants that this authority is dead letter. I'm so glad that today we are starting to change that. I strongly support today's important step toward the goal of promoting market discipline by removing certain obstacles related to designation proceedings that were not grounded in law. It will be important that we now engage in rigorous analysis of certain sectors of the financial system to identify financial institutions that may meet the criteria outlined in the statute. I am pleased that we will be launching a durable process, as the Secretary outlined in her remarks, to make clear that there will be ongoing activity to detect non-bank financial institutions whose failure poses a threat to financial stability and to exercise appropriate authorities. Our goal as a group is that someday in the future, there are 0 of us who have lived through a deep financial crisis, and a lot of recent experience responding to ones should be ones that we hope go away, but that the memories of them do not fade, because risk is always there and our system is fragile. Thank you.
Thank you. Chairman Benham.
Thank you, Madam Secretary, for your leadership, and thank you to Sandra and the Secretariat for all the tremendous work in preparation for today's meeting. Of the congressional authorities the Dodd-Frank Act created in response to the 2008 financial crisis, designation authority by this council is one of the most critical and responsive to the exposed vulnerabilities. Given the vigorous debate among council members on this matter, I support the revised interpretive guidance and analytical framework. With these revisions, I believe the council must use this authority with care and with a clear awareness of its impacts. The authority to designate non-bank financial companies for Federal Reserve supervision fills a regulatory gap of such magnitude that we are bound as a council to be very specific in reaching conclusions when exercising this important and powerful tool. Like the healthy debate and exchange of ideas that brought us here today, we must proceed in any initiation of a designation with a surgical focus on thorough analysis and review of all available data, all with the goal of ensuring financial stability. The council members should work closely and in unison towards any determination. Similarly, I want to thank and applaud the council for reinvigorating the Financial Market Utility Subcommittee. In addition to the non-bank designation authority, Dodd-Frank authorized the council to designate a financial market utility as systemically important under certain conditions. I have long been an advocate of utilizing this authority given the importance of financial market utilities to the proper functioning of our financial markets. And I encourage the council to continue to take seriously our responsibility with respect to FMU designation. I look forward to working with my colleagues on the council in the prudent exercise of these authorities in both the non-bank and FMU space. Thank you.
Thank you, Director Thompson.
Thank you, Madam Secretary, for your leadership on this issue. I do want to thank Sandra Lee and the staff for all the hard work that went into preparing the non-bank designation guidance and the analytic framework. FSOC was established by the Dodd-Frank Act to identify potential threats to the financial stability of the United States, promote market discipline by eliminating expectations that firms are too big to fail, and to respond to threats to the stability of the U.S. financial system. Congress empowered FSOC with tools that it believed would enable it to fulfill this purpose. However, the 2019 guidance prioritized one approach and one tool over all other options available to FSOC, which potentially limited the Council's ability to respond to emerging threats to U.S. financial stability. I believe the guidance and the risk framework we're voting on today do an effective job of ensuring FSOC has all of its tools readily available to address threats that may arise in the future. I'm extremely grateful for the public input FSOC received on the proposed guidance, and I'm encouraged that FSOC took this feedback into consideration to provide some clarity on the meaning of a threat to financial stability, further emphasize its engagement with existing regulators, and expand on the transmission channel discussion. I don't think that Section 113 designations should be an FSOC goal, but I understand the potential for risks to arise in the future that would be addressed best through the FSOC designation authority. I look forward to working with my colleagues on this issue.
Thank you. Chairman Harper.
Thank you, Secretary Yellen, and thank you to the council staff as well as the agency staff for their work on putting this material together. The council's work this year to reconsider the framework and process by which it might designate a non-bank financial company as systemically important was much needed. Having worked on the drafting of the Dodd-Frank Act, I know that that landmark law gave the council a range of tools to address potential threats to financial stability. That toolkit includes the ability and the authority to designate a non-bank company for consolidated supervision and enhanced prudential standards by the Federal Reserve when circumstances warrant it. The 2019 non-bank designation guidance was set up to be an endless game of chutes and ladders. It needlessly hampered the council's ability to consider and use this important tool. The new framework and new procedures will provide us with a more strategic, more effective, and more rigorous approach in the designation process. And with today's finals guidance, it will be balanced, clear, credible, and consistent in how we move forward in that. That is a substantial improvement. The financial market stresses experienced earlier this year clearly demonstrated that problems in one financial institution can rapidly and quickly transmit to stresses elsewhere. As a council, we must be nimble and proactive in anticipating and mitigating those risks. That includes a regular and deliberative review of those entities that may pose systemic risk. And we need to use all available tools, including non-bank designations, to address financial stability risks. The state of readiness and preparedness to act when needed will best allow the council to fulfill its statutory mandate of protecting the financial system from systemic risks. That's a mandate I take seriously, and that's why I strongly support this final analytical framework and interpretive guidance. Thank you.
Thank you. Independent Member Workman.
Thank you, Madam Secretary. I will vote for the two proposals before us today. That said, I want to offer a few remarks about the change regarding activities and entities, about cost-benefit analysis in the determination process, and about the importance of the Council continuing to work closely with state insurance regulators. As Secretary Yellen stated at our April meeting, the Council does not broadly prioritize one type of tool over another. Rather, we plainly examine a risk and design our response to address the risk we are seeking to mitigate. In the proposed analytic framework, it states, the actions the Council may take depend on the nature of the vulnerability. For example, vulnerabilities originating from activities that may be widely conducted in a particular sector or market over which a regulator has adequate existing authority may be addressed through an activity-based or industry-wide response. In contrast, in cases where the financial system relies on the ongoing financial activities of a small number of entities, such that the impairment of one of the entities could threaten financial stability, or where a particular financial company's material financial distress or activities could pose a threat to financial stability, an entity-based action may be appropriate. As for cost benefit, consistent with the logic of making all the tools available to plainly examine a risk and design our response, I believe conducting a cost benefit analysis can be an important tool in the analytical process prior to making a determination. Cost benefit is a tool that is well recognized in federal and state statutory, regulatory, and case law. And I believe it is generally understood by the public as a way to make efficient use of government and private resources. In light of the significant attention given cost-benefit analysis in the comments received, I suggest that going forward, thought be given as a matter of policy to having the Council deem the cost of designation to be an appropriate risk-related factor. It may be difficult to calculate the benefit of a designation in a given case, but calculating the cost of a designation could provide valuable information about the cost that would be imposed on the designee. Turning to the third element of my remarks, I want to emphasize that the insurance sector has a strong, sophisticated state regulatory system. Commissioners, in fact, we have two leaders of the National Association of Insurance Commissioners on this council. And in fact, one of them is in Tokyo as we speak, listening in. In the guidance preamble, it states, quote, "The Council appreciates the expertise and experience of primary financial regulators. Under the final guidance, the Council will maintain its previous commitment to engaging extensively with existing regulators," end quote. In that regard, I'm certain the NAIC will likewise continue to engage fully with the Council in resolving potential risks to financial stability in the U.S. insurance sector. Finally, I want to again express my appreciation for the fine work of staff in developing the proposals before us today. Thanks again, Madam Secretary.
Thank you. And Superintendent Dwyer.
Yes, thank you very much, Madam Secretary. And first, let me echo what all commentators have echoed, which is a thanks to Sandra and staff for all of the good work they have done. So my remarks are limited to the question of insurers as designees. As you're aware, insurers are subject to a vigorous and coordinated state-based regulatory system. A decade ago, my predecessors in this role objected to designating certain insurance companies as financial stability threats, and I've seen nothing in our data or supervisory reviews since that would lead me to disagree. Nevertheless, since then, my insurance regulator colleagues and I have worked hard to further strengthen and modernize virtually every aspect of our supervisory framework of insurers. In every area that FSOC has identified potential vulnerabilities in the broader financial system, we have responded to ensure those concerns don't take root in the insurance sector. We do recognize, however, that insurers can be affiliated with other financial enterprises that may pose threats to financial stability. So it is appropriate to ensure that we have effective designation guidance to deal with such threats. Designations are a blunt instrument, so I would continue to urge FSOC to leverage the primary regulators who have broad authority and extensive expertise as our first and best line of defense against threats to the system. Thank you.
Thank you. Were there any other comments or questions? Seeing none, I think we're ready to vote. First, is there a motion to approve the resolution approving the analytic framework for financial stability risk identification, assessment, and response? A motion.
So moved.
Is there a second?
Second.
All in favor?
Aye.
Any opposed? The resolution is approved. Second, is there a motion to approve the resolution approving the final interpretive guidance regarding non-bank financial company determinations?
I move.
Second,
I second.
all in favor?
Aye.
Any opposed? The resolution is approved. Thank you very much. Our last agenda item is to vote on the minutes of the council's September meeting. Is there a motion to approve the minutes of the September 22nd council meeting?
So moved.
Thank you. Second,
Second.
all in favor?
Aye.
Any opposed? The resolution is approved. And before we adjourn, does anyone have other business to raise? Okay, seeing none, can I have a motion and a second to adjourn the meeting?
Motion.
Second.
Thank you. Thank you. The meeting is adjourned. Thank you.